Good afternoon and welcome. Thank you for tuning in to the halftime report, Navigating the Turbulence. We're here today with David Waddell. How you doing, David?
I'm good. The Fed just released. Hold on, I'm looking at my phone. You keep going.
David may reference his cell phone a few times during this presentation as news is ever flowing. I'm Teresa Bailey, Director of Development and a Senior Wealth Strategist here at Waddell Associates. Thank you again for tuning in this afternoon. We do have a Q&A box down below on your screen if you are joining us through Zoom, and we would love for you to use that feature today. We do have a record number of registrants. I don't know if you know that, David, but this is...
I did not. I should have prepared some comments.
Yes, this is a record number of registrants compared to any other session that we've done live stream this way. And given the turbulence in the market so far this year, that really did not come as a surprise. Speaking of David, over the next, I don't know, 40 minutes or so, David, don't know. You were supposed to get it down to 35 slides. I don't know where we landed on
135.
Over the next, hopefully 40 minutes or so, our CEO and Chief Investment Strategist, David Waddell, will present his thoughts on the current economic conditions. And he also hopes to ease your minds today by providing some clarity. Again, we do, for those of you just joining us, have a Q&A box down below. Please use it. We will try to get to as many questions as possible. Anything not answered live, we will follow up by email. As you registered today, you are required to use your email address. So we do have that attached to your comment. Most of you are pretty familiar with our firm and what we do, but for those of you who do not know, you can find out more information on our website at wealthstrategist.com. And with that, I'm going to go ahead and toss the screen over to David if he is out of his cell phone.
Yes, it's over.
Yes. Okay.
Good.
Let's hear it.
Thank you. Welcome, everybody. Thank you for clicking in and for climbing aboard. I was looking at my cell phone. The Fed has just reported, and it looks like they're raising rates another 75 basis points, 0.75%, which is what we anticipated. There'll be a lot more gyration in the markets over the next couple hours when Powell goes up and does his press conference and does his Q&A. But anyway, the markets took it in stride, rallied a little bit. Dollar is about the same level where it was. 10-year is the same level. So it's kind of as expected right now, which is a net positive. So anyway, sorry, I just had to upload that because I get paid to predict the future. That's what this whole presentation is about. And every once in a while, you want to be sure that you're not really wrong at a singular moment in time like this. Anyway, so thank you again for joining us. You may recall, those of you who joined us at the beginning of the year, that we had a big presentation back in January that we called Outlook 2022, Clear for Landing. And basically the premise there was that 2022 would be a transition year. We were leaving the economy of 2021, which was heavily overstimulated with the COVID stimulus. It was heavily disrupted. And we talked a lot about the turbulence that we might anticipate as we went from that period of overstimulation to a more normal environment, which we hoped might arrive 2023, 2024-ish. And as we all know, anytime you come down from excess stimulus, there are always withdrawals. And we anticipated that would drive the turbulence this year. It ended up being more turbulent than we expected because we didn't really know what Putin was going to do, and we didn't know China was going to lock things down. But nonetheless, we're still in the air. We're dealing with the turbulence. And so now it's halftime, and we're halfway through the year. It's been no fun. But we can look forward to the next half of the year, and that's really going to be the time frame which I'm addressing today. So I've entitled this report, Navigating the Turbulence. And just to set your expectations, there is a lot of stuff in here, but I take this responsibility very seriously, as you know, and I've pared it down to the stuff I think is mission critical. What you should anticipate is, as somebody once told me, the best medicine is laughter through tears. And so that's what you may experience on our flight today. So with that, let's get started. Buckle up. Here we go. All right. This is for the lawyers and also to make T. Meeks happy, who is our Chief Compliance Officer. So take a moment and memorize all of that. and we'll move forward from there. Okay, so let's reassess our dashboard. At the end of 2021, here's where things stood. GDP was again running at this overstimulated level of, call it 5.5%. We had inflation running 7% versus a 2% target, well above target. So GDP above, inflation above. And then bizarrely, we had interest rates at about 1.5% on the 10-year treasury, well below what should be a reasonable target for that. This is where we need to go, okay, for things to be back to normal. We safely land this plane at a GDP growth rate of about 2%. That is the potential growth rate of the country. It had been faster in the past, but for those of you who see a lot of our videos or read our weekly emails, you'll know that we're not creating as many people as we used to in the past, and there's nothing more powerful than a person. And so because we're not doing that, productivity is running about the same, our natural GDP growth rate should be about 2% per year. Accompanying that should be inflation of about 2% a year. That seems to be the sort of harmonic inflation rate that we've been operating on. And then interest rates are probably a little bit higher than that, 2.5%, 3%. So you get positive real interest, but all of that ends up being normal, I think, for where this economy should be. And hopefully we'll get there at some point, because right now things are haywire, right? We've got GDP in the first quarter that was down 1.6%, far away from the 2% target. Inflation registered 9.1%, also far away from the Fed's 2% target. And interest rates, last week were 3%. Today, they're 2.77. I threw my phone away, so I can't be perfect in time. But we ranged from 1.5 to 3.5 over the last 12 months. So things have been pretty haywire, and that's because of all this turbulence we're dealing with. So let's dig into the turbulence. If you recall from the setup back in January, we said there were going to be 3 major turbulences this year. We'd be dealing with the black cloud of inflation. We'd be dealing with a black cloud of valuation uncertainty, and then we'd have a black cloud around governance as the fiscal authorities and monetary authorities probably overacted or overreacted to what is a turbulent environment. So we anticipated that these clouds could make the ride somewhat bumpy, and it has been just that. Now let's tackle inflation first, since this is the biggest, most interesting topic of the day. The Federal Reserve has a preferred inflation measure that they most often refer to. I'm going to get a little technical here, but there's a point. Stay with me. So they track the Personal Consumption Expenditures Index, excluding food and energy. And the reason they exclude food and energy is they don't really have control over food and energy. They can't grow wheat. They can't drill for oil. They can control some other factors, but those tend to pop around a little bit more with more short cycle supply and demand factors. And so this is the inflation rate that they tend to pay most attention to. And as you can see, it's hovered around that 2% line up until late 2021 when it went through the roof, but that started rolling over. So the Fed wants this number at 2, or at least that's the expectations that were set within the marketplace. We've come down from 5.4. Things are heading in the right direction. Why panic? Well, because Jerome Powell has decided maybe we ought to pay attention to a different inflation measure, and that's the Consumer Price Index that includes food and energy prices. And so that includes the full impact of the Russian invasion, with the inflation caused in the oil and the energy markets and the natural gas markets, what's going on in Europe, and also with supposed food shortages, wheat, soybeans, sunflowers, that kind of stuff. So it makes us confused as investors. You've always paid attention to the one that's at 4.7, but now you're directing our attention to the one at 9.1. If that's the one we're supposed to be paying attention to, maybe he'll clarify this today, then there should be a whole lot more interest rate hikes than we anticipate. Furthermore, current inflation is not really what motivates the Fed. What the Fed is really driven by are inflation expectations, because what happened in the 70s was inflation expectations became unmoored, which led to unions demanding larger wages because they felt like we were just in an inflationary spiral, and you had this wage price sort of spiral that led to just continuous inflation. And so the Fed learned a lot from that. And so they really want to manage inflation expectations. Expect that, daily inflation can pop around, but it's really the expectations that matter. Well, their favorite measure for that is one that the marketplace actually sets, called the 5-year forward inflation expectation rate. They want this to be 2%. It's always a little bit above 2%. You can see that kind of in this chart over time. Right now, 2.09, it was 2.11 when I checked this morning. Not far from really what their expected rate is. So the Fed still has credibility in the marketplace. People think this inflation is transitory. And then all of a sudden, Powell says, well, maybe we should pay attention to a different inflation rate. Maybe we should pay attention to the University of Michigan inflation expectations rate. And that is a survey basically of households across the United States of America. Well, the thing that really drives households' opinion of inflation expectations is the price of gasoline, which has obviously gone up a lot, started to drift lower, but it's gone up a lot. And so the answer to the question is, yeah, we expect inflation to be really high. Well, the Fed's never really paid attention to that measure before. Powell brought attention to it. It's confused things a little bit. Well, therefore, what really matters when you're baking all this in as a forecaster is, what are interest rates going to be? Now, this is the actual sort of the real interest rate out in the marketplace. They've set a range before 30 minutes ago, between 1.25% and 1.5%, which averages out to about 1.63. So this is the effective federal funds rate. You can see they jacked it up in the 16 through 19 cycle, cut it when they realized they over tightened, and then we had COVID, which took the rate to 0. And now they've started to raise it in reaction to inflation. So trying to figure out the body language of the Fed, the market believes that the Fed will raise rates up to, call it 3.38 by the end of the year. And then they'll cut rates next year because the market sniffs maybe a recession, maybe an over tightening. They're certainly expecting inflation levels to come down. So maybe we're at 2.94% at the end of next year, and then 2.71 the end of the year after that. So the market, looking at the traditional measures of consumer price index X, energy and food, and also looking at the 5-year inflation expectation, 5-year forward, is at that level, while the Fed, evidently incorporating these new measures, is well above that. We're going to be at 3.4 at the end of this year, 3.8 at the end of next year, and then maybe we'll cut rates. But there's almost a 1% spread there between what the Fed thinks and the market thinks. And this has created a whole lot of marketplace confusion and a lot of turbulence around rates. Now, all of this gets folded into what's known as the yield curve, which is what I'm showing here. And this yield curve at the end of last year was very nice. You had low rates of interest in short maturities like 3 months, and then you had higher but low rates of interest out to the 30-year at 2%, and it was sloped nicely vertically the whole way through. Today, the yield curve is negative and flat, so the whole thing has moved higher, which means that the yield curve sniffs out some inflation, but then it's also inverted, which means that the yield curve also anticipates a recession. So we get a little bit of inflation, we get a little bit of recession. This is a recipe for stormy clouds and turbulence. So that's what's going on with inflation. Hope that was clear. And if you're seasick right now, stick with me, it gets worse. So in terms of valuation, what drives valuation? Guess what? Inflation, right? So here's a chart of the S&P 500 PE ratio, which is the measure of valuation for the US stock market, at least the large cap index, going all the way back to 1960. And you can see it vacillates or oscillates, whichever you prefer, around an average of, call it 16 or so. Well, what causes the PE to go down? High inflation. So the highest inflation on record really occurred back in 1980. Inflation levels hit 15%, and PEs were actually in single digits. It was a great time to buy, by the way, because Volcker did crush inflation, and those PEs went up for a long time as inflation went down. And PEs peaked in 1998 with an inflation rate of about 1.5%. And then we can see they also hit that similar level recently when inflation was sitting around 1%. So there is some noise in valuations over time, but there's a clear connection between what's going on with inflation. If inflation's higher, the PE's lower. If inflation's lower, the PE's higher over time. Now look at the right side of your screen at the collapse we've seen recently. Well, when inflation went up another 8% to 9%, the PE collapsed faster than it ever has in history, down 30% on the S&P 500 to where today we're sort of at an average valuation level for the S&P. So what we have to figure out going forward is which inflation rate do we think will persist, because that'll drive overall marketplace valuation forecast, right? So if we are in an environment of 9% inflation perpetually, then what we should expect is the PE to drift back down. So historically, when inflation was between 8 and 10%, the PE was about 9.5, which means that this market right now is wildly overvalued. And you'll hear several people in the media and on the internet, the interweb, talk about how wildly overvalued we are because inflation has come unmoored. It's the 70s and the PEs need to be cut in half. Well, I don't know whether that's true or not. We'll get to it. Maybe not. And if you believe that inflation will actually come down from here and revert to the mean and get back towards that 2 to 4% range, then historically PEs could be higher than where they are today, which would imply that there's market is undervalued at a 16 PE, and that 17.5 and 18 should be where the PE lands, given the fact that inflation should be over time about 2%. So if you believe inflation is going to be high, this market's absolutely overvalued. If you believe inflation is going to fall down to normal levels, then maybe this market is undervalued. It's a lot to consider. Oh my goodness. But then go down into the small cap universe, S&P 500 large companies. Small cap companies are much more economically sensitive. And what this chart shows is that small cap PEs are all the way back to where they bottomed in the great financial crisis. So this looks like not only are we worried about inflation here, but we're also worried about recession. In fact, we've priced in enough trauma in the small cap universe to take valuations back down to November, I think, of 2008. Feeling queasy? Feeling uncomfortable? Now let's talk about government. So there is some leadership turbulence abroad. I'm sure you recognize this individual on the left. This is Vladimir Putin. He runs a country called Russia. He decided to invade the Ukraine. Oil prices went through the roof. Wheat prices went through the roof. And then a bloc formed. And Modi in India said, hey, we'll buy some of this oil. And then Xi over in China said, I get that there are sanctions, but we're not really going to participate. So we'll sell you stuff if you need it. So a bloc has formed around Putin and Modi and Xi, and some of the Latin American companies are sort of included in that as well. But there's definitely leadership turbulence, obviously, in Europe and the Far East. And then you got Draghi, who just resigned in Italy. They're considering Italy again. And you got Boris over in the UK. He got tossed, or he resigned under pressure. But obviously that's been, lack of stability there for the UK. And then the entire Sri Lankan government resigned after the government decided that they really wanted to pursue only organic farming. They outlawed fertilizers with any chemicals. And so they didn't have any fertilizers. And now everybody's starving. And so they had to go. And then even worse, and most traumatically, the architect of Abenomics, Abe in Japan, was assassinated recently. Very sad, great guy. So there's plenty of leadership turmoil abroad that's impacting the markets. And we have our own leadership turbulence here at home as well. When Joe Biden took office, he tried to pass the largest spending bill in the history of spending bills, right on the back of the largest rescue bills. And so he wanted to put $4 trillion more into the economy after we basically put $5 trillion in with the pandemic stimulus packages. And he ran into a brick wall named Senator Manchin, who basically said, I think this is just going to stoke inflation further. And he ended up being the deciding vote that's basically blocked almost every spending bill that Joe Biden has proposed, leaving Americans to be a little bit concerned maybe that the government's a little tone deaf to the tune of inflation or their needs. And so let's get out of DC and ask across the United States of America, do Americans think we're on the right track right now as a country, or do they think we're on the wrong track? Well, here's the data. So 72% of all Americans think we're on the wrong track. Now, 17% think this is great and we're on the right track. I don't know any of those people, but 17 of us believe that we are on the right track. That may not be all that surprising, but what is surprising is while 86% of Republicans think we're on the wrong track, 62% of Democrats think we're on the wrong track, and 71% of independents think we're on the wrong track. Well, remember, we also have a pretty important election coming up in November. This is a midterm election year, and a swing in Congress can change the contours of what's possible legislatively. So let's take a look back at previous administrations and their success in the midterms based upon some other factors. All right, so this is going to be a busy chart, but basically I've got all of the midterm election years going back to 1974 and their associated presidents on the left side. I'll start with the presidential approval rating. At your top bar, horizontal bar, is the average. So the average presidential approval rating going in the midterms is 51. The highest presidential approval rating was 66, which was Clinton 2. The lowest is Joe Biden right now. So Joe Biden's at 38% approval. That's less than Trump, less than everybody in this slide. What about congressional approval? Well, people never like Congress. They normally like them 30%, but currently they like them 18%. So they really don't like the president. They really don't like Congress. And in terms of U.S. satisfaction overall, going back to Clinton 2, 60% of us were really satisfied that the U.S. was heading the right way. And right now, satisfaction overall is about 16% with the legislators, the directions of the company. It's a very unsatisfied voter base. And what's driven that a lot, as somebody smart once said, Carville, I guess, it's all about the economy, stupid. Well, if you look at those approval ratings for Biden that include presidential, congressional, and satisfaction, they're all linked to how good people feel about the economy. Well, right now, their opinion is negative 32%, which is a little bit less than their opinion of the economy back when Obama was, running into his midterms in 2010 after Obamacare and with Brexit and all that. Highest levels were Clinton 2. That was all back during, the boom in the stock market, and we got towards balanced budgets, and there was a lot of stuff to celebrate. So how does this all filter into what you should expect from the midterm elections? Well, on average, the incumbent party loses 23 seats, right? The most seats lost were 2010, Obama won, which does correspond to the lowest reading on economic conditions. So he lost 63 seats. You look at this, Clinton 2, it's the economy stupid. People felt very good about the economy, and he actually picked up seats in Congress. But on average, the incumbent loses 23. I'm not a betting man, I'm an investment man. But I would guess if you look at the midterm elections, it is not all that favorable as an outlook for the Democrats. So we've got turmoil in politics abroad. We got turmoil in politics at home. We've got three major turbulences. We've got this inflation storm cloud, the valuation storm cloud, the government storm cloud. I mean, basically, you should start feeling a little ill because the turbulence that's happening out in this world translates directly into turbulence within the market. So this is a chart that shows a percentage of the last 100 trading days with moves in the S&P 500 greater than 1%, right? Basically measures turbulence. So you can see there are moments where we've hit high points, and they also correspond with moments that you may recall. So we had the bursting of the dot-com bubble, which was a fairly turbulent time. We had the great financial crisis, which was a fairly turbulent time. We had, it was Portugal, Italy, Greece, and Spain that were almost evicted from the Eurozone. Remember, the Euro was going to collapse. And so Brexit was a real volatile, anxious time. And then, of course, we had the COVID pandemic that occurred in 2020. Market dropped, 40% overnight, basically. That was a pretty turbulent time. But based upon the volatility we're experiencing, the three turbulences of inflation, valuation, and governments basically measure right up there with these other very scary moments for investors. And unfortunately, all of this volatility leads people to sell. It just becomes wholesale liquidations of assets. So here are the returns for the first half, not WNA's returns. Here are the returns for the first half across various asset classes in 2022. Now, if you had a portfolio that was 100% gasoline, natural gas, and wheat priced in US dollars, you had a really good first half. If you owned anything else, you had a really bad first half. Gold was down, bonds were down, stocks were down abroad, emerging markets and international stocks were down, actually a little bit less than the US stocks, which were down. Small cap stocks were down. And then, as you know, tech stocks were just taken to the woodshed. And then, just to save you from further misery, I did not include cryptocurrencies on here, but obviously they've not had a real good run in 2022. So at this point, you should be fully nauseous. The good news is, on the plane, we do have a baggie in the seat pocket in front of you if you need it. But I'm going to try and get us out of these storm clouds. So let's look forward now to the rest of 2022 and see what we can expect. Trying to pull our plane up a little bit, trying to gain some altitude. Let's get out of the storm clouds. All right, first of all, everybody just come to grips with the fact that we're probably, if not in recession, close to one. So just get comfortable with the fact that recessions exist. They happen statistically 66, 70% of the time. So 30% of the time we're in recession. Well, right now, the probability of recession, according to Bloomberg, is 72% between when they did the survey in May, basically, and first quarter 2024. So it's recession. But not all recessions are created equal. It's important to figure out which recession we're going to have. Each of these declines on the right, and this is post-World War II recessions and their corresponding GDP declines, each of these large recessions was associated with a crisis. 1957, which was super helpful for us as we navigated COVID, was a pandemic. It was a recession. It was the Asian flu. Many people died. There were a lot of voluntary lockdowns and school closures and things like that. Ultimately, there was a vaccine. We moved forward, helped us navigate through COVID by studying it. But nonetheless, it was a recession driven by a pandemic. In 2008, we had a recession driven by a great financial crisis where the entire financial system almost collapsed. In 2020, we had a huge recession, mostly driven by policies to lock the economy down as, a vaccine for the COVID infection. In 1937, most people don't know this, but this was the Roosevelt recession. We embargoed, we outlawed imports of gold, which shrank the money supply. The Fed raised rates. It was just a mess. So basically, that was a governance policy crisis that created an echo Great Depression recession back in 1937. 45, we had World War II. 20 million, Americans jumped offshore and went to fight. That's not good for your economy. And then 1929, obviously, we had the Great Depression. So each one of these recessions also had a crisis. So if you combine a crisis with a recession, your average drawdown in GDP is a horrendous 13.4%. What if you don't have a crisis? Well, if you don't have a crisis, they're somewhat benign, right? So if you look at two that are of real interest to me, 1980 and 1981, because the Fed deliberately put the economy in recession to deal with inflation, which might be bubbling up in their heads today. We lost 2.2% of GDP in 1980. We lost 2.6% in 1981, really fairly benign. And so if you don't have a crisis, the recession averages a GDP loss of 1.9%, okay? So recessions happen, that's okay. What we need to really dive into is, are we on the edge of a crisis? If we are, then we have to do some things. So let's see if we're heading into a crisis. Well, just to survey, and let's start with households. Household balance sheets right now are super strong. Remember all that stimulus? A lot of it was invested. It went into houses, it went into stocks, it went into cash. And so household net worth is still, this is as of March 31st, 35% higher than it was pre-COVID. So household balance sheets, assets minus liabilities, are really very strong right now. And household employment opportunities are also very strong. There are 11 million open positions in the economy right now for 6 million unemployed workers. So let's say half of those job opportunities go away. It's still 1 for 1, which is really pretty strong just historically. So if half of the job openings go away, it's still a strong employment market for those who are unemployed. And if you look at wages, right, because you've got high demand and low supply for workers, it pushes up wages. And if you look at the last, 3-month moving average of the wage growth per the Atlanta Fed, wages have grown 6.1%, which is, extremely strong. So even if that cools, you're still above the long-term average. So balance sheets are strong, job opportunities are strong, wages are strong, and this is perhaps the most informative chart of all. Household debt service is low. And by household debt service, I mean, how much do you spend of your income on interest payments and principal payments on loans outstanding? I mean, we're down from 13.5% to 9% since the great financial crisis. And obviously the households were over-levered going into that one. And the cost of servicing the debt was very high. So unemployment rates spiked and they couldn't make the payments, and that led to bank defaults, et cetera. But right now, household debt service is almost at a record low, and certainly well below where it was in 2007 and also back in 1980. So the households are in a really pretty good spot should a recession arrive. What about corporate balance sheets? I don't love this chart, but basically what I'm showing you is that there is plenty of free cash flow for debt coverage across corporate America, plenty of cash flow for interest coverage. We've not seen some ballooning up of debt obligations layered against what companies are creating in free cash flow. So companies' balance sheets are strong, consumer balance sheets are strong, and all of that ricochets back into the banking system. Now, after 2008, the regulators, remember Graham Dodd and all of that, put a whole lot of restrictions on the strategically influential banking systems and said, you got to subject yourself to stress tests. You got to carry a whole lot of extra ballast on your banking sheets, on your balance sheets. And so if you look at bank balance sheets today, they're extremely strong. In fact, the Fed just tested 33 banks and all of them passed. There were some recommendations, and in those stress tests, they anticipate a really bad recession and a really bad stock market and really high unemployment levels and all the sort of uglies, but they passed. And you can look at this chart and see that the actual amount of loans they have outstanding relative to the deposits they've got on their balance sheets has collapsed almost in half since the great financial crisis. So there's not a liquidity crisis in the banks by any means. And based upon their balance sheets, they're very strong. So households are strong, corporations are strong, banks are strong. Who's weak? Well, here's household debt to GDP going back to 1970. And you can see it ran up way too high in ahead of the financial crisis, but since has come down from 100 to about 75% or 77 here. And so households have been repairing their balance sheets. Corporate balance sheets have grown some, but like I showed you, at a very manageable level. So business debt to GDP, a little bit higher than households, but still at a very manageable level. It's the government where the debt burden has ballooned. We went from 40% debt to GDP, basically pre-financial crisis, to about 111% debt to GDP. So I get a lot of questions about this. People freak out and they go, okay, there's got to be a crisis here. The government is way overburdened with debt. What does that look like? Do I need to get out all my dollars, put everything in gold or the ruble or, some other form, Bitcoin of currency or store of value, because this cannot persist? Maybe. But if you look at the dollar, right? If we're in crisis, then the dollar should be declining. Instead, the dollar's at a 20-year high. This is the dollar chart going back to when Nixon closed the gold window in 1971. And you can see that it vacillates around. But where we are right now is a very high level relative to history. So the Globe has voted and said that the creditworthiness of the United States And the attractiveness of the US dollar is at a 20-year high, even though we're running these high debt to GDP levels. By the way, so is everybody else. And remember, the dollar is a relative instrument. So no crisis in the household sector, no crisis, I don't think, in the business sector, no crisis afoot in the banking sector, and no crisis afoot right now in the government sector. So perhaps crisis is averted. So I'm pulling on the stick, trying to get us out of these storm clouds. Stick with me. There's still more work to do. We're not there yet, but we're making progress. I love these slides. Thank you, Nicole. All right. So the question is, where should the S&P be? Let's filter all of that into trying to figure out how to forecast the right level for the stock market. All right. This is current earnings forecast from consensus opinion among the analysts for the S&P 500. So you've got actual returns, or excuse me, earnings per share up until 2021, and then you have a prediction for 2022 that they're holding on to. They're actually still predicting, knowing all the things I just showed you, 10% earnings growth this year. And in 2023, analysts are predicting additional growth of 8.7%. Well, let's just say that's too rosy. Those estimates need to come down. It's recession. So you need to adjust all of your earnings forecasts for the reality of what happens historically when recessions hit. So let's look at that. This goes back to, I think, the post-war period and says, how much do S&P 500 earnings decline during recessions? This includes the crisis recessions and the non-crisis recessions. Well, you can see in certain instances like 2008, it was a total washout. I mean, the financials went to zero and they're 25% of the index. And then you had obviously blowback through other industries. That was pretty terrible. And you had the 2000 Y2K collapse, right, in earnings because everybody bought too much technology leading up to Y2K. And then those earnings collapsed as there was no reason to continue spending at that pace. And so you could see there are some interesting stories in here. But if you go back to the ones that are most relevant, I think, for this point in time, in 1980, S&P 500 earnings fell 3%. 1981, they fell 13%. Those were the two recessions that the Fed manufactured to deal with recessions. So I find that interesting. If you average them together, it's down 8, if I did my math right. The median in terms of S&P 500 earnings decline during a recession is 13%. So that's basically what we hit there in 1981. So keep in mind the median in a recession down 13%. Now I'm going to make you do math. And I'm sorry for this, but if we're going to come up with a forecast for year-end 2022, we got to start somewhere. And I'll even go beyond that as we move forward. But let's start with the PE first. Okay, I've got all these boxes here, and they tell you that at 2021's high, the market was trading basically at a PE of 23, right? Because inflation was low. And then at the 1980 low, the PE was actually lower than 9, but I ran out of space on the slide. So we'll just call it 9, right? But obviously when inflation is low, PEs are high. When inflation is high, PEs are low. The last 15 years have averaged 16. At the end of the first half, the PE on the market, as I've shown you, was about 15.9. Now, to forecast where things are going, we have to then multiply the PE times our expectation for 2023 earnings. So right now, as I showed you, the analysts estimate earnings will be $250 a share. That's a 10% gain in 2023. That's great news. But maybe that's not true. Maybe there's no growth next year. If that's the case, then earnings will be $229 a share, which is where we'll likely end this year, if they're correct. In terms of 2023, let's say we have a mild recession estimate, $217 a share, or 2023, we have a median recession, right, which is a 13% drawdown. Mild recession is about a 5% drawdown, 13 for median recession. And then let's say we have a crisis and a recession, then you can anticipate that earnings will fall, call it 20%, and that'd be pretty nasty. So to get our range of returns, if you're still awake, what you got to do is multiply all that stuff together. Now I'm going to make this easier, but this is our matrix of potential year-end target levels for the S&P 500. Understand that we closed out the first half at 3785 on the S&P. So if we try and figure out where that is in our matrix and we look at our PE, basically what that says is that the anticipation was that earnings would be positive, but less than the estimates, call it around 5%. So our range was that we'd have maybe slower growth than anticipated, but not outright recession, buttressed against a PE of 15.9, because obviously people thought inflation was rising. Now, the question is, do you think inflation will rise or fall from 9.1%? If you think inflation will fall from 9.1%, then you can make a case for a higher PE, okay? So let's just play that out. Say more likely that inflation falls than rises, therefore more likely that the PE rises than falls, and so we'll just pick a range, 17 to 19. Then you have to make a prediction on earnings across the S&P 500. We've shown that the severe recession is off the table, I think, because there's no crisis brewing. In terms of that median recession estimate, if we go back and look at the recessions that the Fed manufactured and therefore well telegraphed, earnings on average were down, call it 8% between the 3 and the 13 and 80 and 81. And so companies can sort of figure things out. And you've seen that already. Layoffs have been announced and people are husbanding resources and projects are stopping and funding is freezing up, which is what the Fed wants, by the way. But companies are preparing themselves for whatever this recession may turn out to be, if it turns out to be. So let's pick this as our range. We're either going to have a mild recession or we're going to hit the rose-colored glass estimates of the analysts, but that's our range. So our range is 3696 to 4750. I'll convert that to percentages. So we closed that first half again down 21% or so. The low is down 24. Second half return potential based upon this analysis is somewhere between down 2% to up 25% to end the year. That makes me feel a little bit better. Maybe you as well. Laughter through tears. The other thing to consider is that the market went down 24% top to bottom, which is basically the median for how much it has gone down through all of the recessions that we've been analyzing. So the market has, at the median, fully discounted that this recession is going to occur. Now, if it turns into a crisis, a la 07 to 09, things could get a whole lot worse. But this chart does suggest that we've been talking about this, and therefore we've been discounting this, and maybe it's already been fully discounted at down 24%. That's the median. And here's an interesting point. That happens before the recessions actually hit. During recessions, from the day it starts to the day it ends, stocks typically advance on average. So this is a chart that goes back and said, how did the S&P 500 do during the recessions since 1945? Not before, which is basically what we saw in the previous slide. And as you can see, more times than not, it's actually up. And in fact, if we go back to the two that were widely broadcasted, 1980, 1981, the S&P was up 16% during the recession of 1980 and up 10% during the recession of 1981. Now, obviously, COVID was a surprise. Obviously, the great financial crisis was a surprise. And then we had, 9/11 back in 2001, which was also a surprise. But on average, during recessions, markets actually go up, call it 4%. Feeling better, getting above the clouds. I'm going to take you a little bit higher. All right, here's the upside of feeling down. This is the Consumer Sentiment Index, which measures basically whether you're optimistic or pessimistic, going all the way back to 1971. And as you can see, right now, we're at a record low. This is the most pessimistic that U.S. consumers have ever been in any environment since this index was created. Well, what does that tell us about future returns? This is the returns 12 months forward after each one of those other sort of nadir, most pessimistic moments. So in the 70s, felt bad, went up 22%. Back in 80, felt bad, went up 20% 12 months after that. 90, 29%, you can read the numbers. End of financial crisis, up 22%. August 11, Grexit, up 15%. And then we recently had this COVID pandemic low, if you've forgotten, in March of 27th of 2020, the markets went up 44% over the next 12 months. So we're at a record low right now. Where are we 12 months from now? I don't know, but with history as a guide, it's typically a great contrarian indicator. We'll revisit it in June of 2023. And then there's the upside of actually being down. Like, do 2 quarters in a row of negative returns foster 3 quarters, 4 quarters? Like, when does the fever break? So these are all of the 20% plus 6-month drops for the S&P 500 post World War II. Okay, and that's not a huge sample space, so as a statistician, it kind of bugs me, but definitely pick up some patterns here. So we were down, like I said, 21% in the S&P the first half of the year, and here are the other drops for other corresponding periods. What happened over the next 3 months? Well, it wasn't all positive, right? Back in the financial crisis, we had sort of this rollover event, if you remember, in March of 2009. So markets actually were 12% lower the next quarter after that 2-quarter drop, but that's the only one. The rest of them were positive, and when you throw it into an average, 8.5% higher over the next 3 months. Coincidentally, that's what's kind of going on in the market right now. And also, just so you don't think that I'm coincident, I did build this presentation like a month ago. So the run that we've gotten has been irritating to me because I should have said this all a month ago. Nonetheless, so over the next half, after each one of these miserable environments, all of them were positive, and the average was 21% higher over the next 6 months. And then we go into the next year. I mean, you can see the numbers, they're pretty amazing. The average gain after a 2-quarter drop over 20% has been 31% over the sample space. Pretty darn bullish. So there's upside to feeling down, there's upside to being down. And then there's the midterm election year. Bear with me, I'm getting close to landing this plane. On average, a midterm election year is negative through the month of June. It's turbulent, negative through the month of June. We had done this analysis and sort of told you this back in January to just sort of get through it. Didn't expect it to be, like I said, as bad as it was with Russia and China going astray. But nonetheless, on average, US stock market, midterm election year, negative through the month of June. And there are also some sizable corrections. You may have forgotten this, but the last time we had a midterm election year, it was 2018, and the market went down 20% from its highest point to its lowest point during that year. And you can see 2022, we've gone down 24%. But on average, during midterm election years, you actually experience a 19% correction, not too far from where we ended up. The nice part of that, though, is that once you get past that, the recoveries tend to be tremendous. So after we went down 20% in 2018, we went up 37% over the next 12 months. What'll happen this go round? I don't really know. But after average declines of 19% during midterm election years, you see average recoveries over the next 12 months of 32%. So that makes me feel a whole lot better. Maybe you as well. Remember, laughter through tears. So the second half, going back to that composite line for a midterm election year, tends to get a whole lot better in the second half, right? We get an upward bias coming through July into the election, but then once we get that behind us and we have clarity on the governance, and I expect it to be gridlock, which is good for markets, then you could see a substantial leg higher. Now, everybody knows this that does the job I do. And so people tend to buy in advance of these events. That may be some of the stuff you're seeing now. All right, so I'm going to land the plane. So we talked in the first Outlook presentation back in January about these 3 turbulences and predicted how we would get through them. So here's how we've safely navigated so far. We said, based upon our inflation read, that COVID inflation would prove to be wartime inflation and not the Great Inflation 2.0. What I meant by that is that COVID was really World War C. The globe reacted to that just like it would have to a global war conflagration, which is inflationary, but that ultimately that would pass. And that it wasn't the Great Inflation 2.0, which would be a whole bunch of horrendous policy decisions like we got throughout the 70s. And that wasn't going to be the case because the Build Back Better bill wasn't going to pass, which it didn't. So the halftime status on these predictions, true. COVID and the Russian invasion, which took oil up, took wheat up, is really wartime inflation. I'm not convinced that we've got policy inflation to the degree that we suffered under back in the 1970s. I still think this is transitory. It's just been kicked down the road a little bit because of what happened with Russia and China. All right, from a valuation perspective, we did a lot of work in that. And we talk about when inflation rises, valuations fall. We all know that now. The S&P at the time was very expensive coming into this year. Everything else was cheap. And so we tried to hide in other areas of the market, international, small cap, places with lower PEs, and it worked. The S&P did underperform those other areas, as I showed you, but I think valuations have largely reset. In fact, as we discussed, there might be some room for the S&P 500 PE to actually climb higher. Certainly a lot of room in small caps, a ton of room in internationals, and I wrote about that last weekend. You can refer to that on the site. In terms of the governance turbulence, we said the Fed's bark will be worse than its bite. Once I get off of this, I'm going to jump on and see what Powell's saying in the press conference, but my guess is there's a little bit of softening in some of that language. If not now, then a month from now or 2 months from now. And that President Biden's inflationary agenda will cost the Democrats the House and likely the Senate. Spent a lot of time sharing with you our forecasts on that. It's to be determined because it's not the end of the year. So the Fed's bark and its bite and President Biden's success in the midterms is yet to be determined, but I like my odds. All right, so here's the bottom line. In terms of equities, I think they're higher going into the second half. They already are, which is why I'm irritated I didn't tell you this a month ago. In terms of size, I think small caps outperform large caps because they've got such a valuation advantage. And if the analyst community recognizes that the drawdown in earnings for an average recession isn't going to be that great, then they look really cheap. In terms of style, when you get into a recessionary environment, the pendulum does sort of swing back into growth. I think that's somewhat temporary. I think value has a lot of runway here. But I would expect between now and the end of the year that the growth names pick up a little steam. And we're talking about that a lot on the investment committee, trying to find ways to do that, if it's even worth doing. In terms of the US dollar, I think that can roll over. I think it can move a little bit lower because if the Fed softens its stance, and by the way, Europe hardened its stance, then you've seen a little, drift in the dollar lower just within the past couple of weeks. I think that can persist. So the international earnings, which have been or returns, which have been on par with the U.S. despite a 10% currency headwind, to me, look poised to outperform as the dollar sort of rolls over. So, it's hard to forecast currencies, but that's what I think. In terms of U.S. interest rates, maybe moderately higher, but I don't see them running away because those long-term inflation expectations are in line. Plus, we got this recession call sort of circling around. So I don't think interest rates really go anywhere. The Fed tightens, but I think they tighten less than expected. In terms of bonds, great news. We've got yields again. If you look at high yield bonds, you can get 8%. Good corporates, you can get 4 to 5. Our bond funds are generating cash flow again. So their yields in bond land, that's pretty good. So I don't think we'll see the same kind of damage we saw in the first half of the year and the second half of the year, and people can clip coupons now in bond land, which is great. The primary threat is Powell. If he stays committed to trying to manage inflation in oil and in wheat and all these other things that the Fed really has no ability to manage without crushing demand to a huge degree, then that would be bad for this forecast. Again, I have to listen to the press conference, but I don't really think that's where he's headed. All right, I'll leave you with this, right? A lot of people will say to me, I just think it goes down a lot more. I want to raise cash. We had a couple of those calls with clients this week. Many of you haven't had that conversation with us. This has actually been a pretty resilient crowd so far in this period, probably because real estate prices have held up. But this is the bell curve of the US stock market, right? So you can see out on the left, 1931, we had a year where markets were down between 40 and 50%. Out on the right, we had a couple of years where markets were up 50 to 60%, very close to each other, actually in dates. And then you can see the zero line right in between. So the bell curve skews to the right. So it's much more likely to have a year up 35% than a year down 35%, right? That's what I mean by the skew. So in 2021, we were up 25%. In 2022, we were down 20%. Could it go down further? it could. There are 96 instances, I think, on this chart, 6 of which have actually been years 1931, 2008, 37, 2002, 74, and 30 that were worse than where we closed the first half. That gives you about a 6% chance that that occurs. So it's very rare. And if we're not having a crisis, if there isn't some sort of, nuclear event, there could be, who knows, then there's really very, very little case that can be made for another 20% decline from here to put us right in range, with the Great Depression. I just don't think we're going there. So the good news is that the first half was terrible, but the second half should be a lot better. And we're positioning portfolios and client accounts as such. We did take advantage of the downturn, though, by again ducking many of those declines, but also harvesting a bunch of tax losses. From here, I just think the clouds part and we can get above them. So those are my comments. No idea how long that went. Teresa, I did lie to you. It wasn't 35 slides, but I'm open to questions if there's anybody left on the call.
Yes, David, I feel better, and I imagine that I am not alone. So
Great.
To you, David, as well as Nicole Bean on our team, who you referenced earlier, thanks so much for all the work that goes in. It may have taken you a month to put it together, but it was well worth the wait. All right, questions. We've had some come in. Everyone, if you have any, please continue to put them in the queue, and we will answer them either here live or by email. There are several questions, David, I see about the presidency changing, and we've got many different names. So can you just generally speak to if the presidency does change, moving forward, what effect will that have on the market? Maybe just speaking to the effect that political decisions have overall.
Well, the president's not up for election in November. That's obviously Congress. So he's got another couple of years. So unless he gets taken out, I mean, you'd still have the vice president. So your party affiliation would still be Democratic. So unless there's, some sort of alien invasion, I don't see any change in the White House. So it's really about Congress. What that does is it gridlocks thing. I mean, the Democrats are still trying to get through a dismantled version of the Build Back Better agenda. They were trying it last week, still trying to jack up taxes and do some other things. And I am not revealing whether I'm a Democrat or a Republican. I'm just commenting on the facts. And Manchin stymied them again. So while they've got this sort of relative advantage in Congress, there's still a threat that we get rid of, grats and, estate laws change or whatever. If the Republicans sweep in November, which I think they will, then you get to not worry about government legislation. And then we got 2 more years to think about it. And the third year of a presidential term ends up being the highest return for the stock markets because the president's trying to sort of goose the economy going into his reelection campaign. Plus you've got gridlock and companies know, because things are more certain legislatively, how to navigate. So I do think that, again, the Democrats lose, that creates gridlock. That's a positive for the market. In terms of what happens down the road when Trump-Biden 2 occurs, I don't even want to think about that yet. We'll deal with that later.
And I think one question specifically may have been to the current president's age. If something were to happen to him and we had a change there, would that have a dramatic impact?
I mean, my own sort of personal unfiltered opinion is I'm not sure that a lot of what he's doing is coming from him anyway. So he may be a vehicle for some of those policies. I think Kamala would be just as well. So I don't think there's any change there, really. It'd be tragic, but I don't think there'd be any change.
Got it. And then one question, which is interesting, and it's been such an interesting time for them. But one comment is, why have the bonds right now if they're just going to be a loser?
Well, they're not anymore. They're yields again. So the bonds have actually picked up a little speed. We had that move higher in rates from 1.5% to call it 3%, 3 and change on the 10-year. Those rates have come back down, which is actually good for bond prices. And since, we're now pricing corporate bonds, et cetera, off a much higher yield curve, which I showed earlier, you get higher yields. So you're getting higher yields across those bonds now. And you're also getting a little bit of capital appreciation because people are fearful of some recession. So the bonds are creating positive carry now, which will diffuse a lot of the damage that was done in the first half. Remember, bonds, by the way, are portfolio insurance, more or less. It didn't work out this year because the bonds declined, but on average, over a long period of time, they earn 5%, right? In a yield environment of 0%, they have a whole lot of trouble earning that 5%. So if you get back to where you got yields at 3%, you can price corporates at 4, 4.5, 5, depending on quality, and then you can move up to 8 and high yields. You can start getting back to more normal rates of return for fixed income. I mean, we've really been out of sorts in bond land ever since zero interest rate policy and all the quantitative easing and stuff happened. Now we're out of zero interest rate land. We're quantitative tightening, and you're getting yields, which compensate you over time for holding the security. So I actually think bonds are back in favor to a certain extent, given the array of information I have today. So the positive carry on bonds the second half will be refreshing.
Nice. And here's a comment about real estate. The housing and real estate markets are beginning to show signs of downturn. What impact, if any, does that have on markets?
Yes, I did a deep dive on this, I think 2 weeks ago. So if it's posted on the website, please dig into it. You're right. Mortgage levels this morning came in at I think all-time lows or something. And lots of people are backing away from the table. The showings are down, et cetera. Housing prices need to come off boil. The affordability for U.S. housing has been just atrocious. And if the Fed wants to get inflation down, within the CPI, rent inflation is like 40% of the CPI. Within their preferred measure, the PCE, it's like 20%. So they can't get inflation down unless they get rents down. They can't get rents down until the prices for housing start to fall. That has occurred. So we've seen a bunch of price cuts recently. The median sales price is coming down. So, but remember, back in 2008, when we had the financial crisis, it was because there was a whole bunch of negative equity in real estate when the prices came down. Now consumers are in much better shape. There's a whole lot more equity. So the prices can come down without flipping people upside down. So I think you can take some of the, price gains back, which is what's going to happen, without impairing the consumer, right? They got all this net worth, they got good jobs, they got wages. And if you're not going to impair the consumer, then the banking system should be okay. So I think the economy can tolerate a drawdown in housing prices, which it couldn't really tolerate back in 2008, because again, the corporate balance sheets are strong, the consumer balance sheets are strong, and the bank balance sheets are strong. So it is by design. The Fed needs rents to come down. They come down when prices come down, and that's just, but I don't think it creates a ricochet effect like it did before, where it puts us into some sort of crisis.
All right, we've got a question that is both, well, you just answered the real estate part. How about gas prices? When will gas prices drop?
That's tough. Recessions make oil prices go down. The other factor is that Russian oil is finding its way into the marketplace. So oil has now round tripped to where it was the pre-COVID invasion. But because we've cut back on so much refinery capacity since we've outlawed gasoline basically in the United States of America, the crack between oil prices and gas prices has gotten very, very wide. So it's really the refining capacity that's been taken offline that's creating this delta, if you will, in prices. But they have started coming down. But at the current policy array and the restrictions on energy production, the green agenda, whether you're for it or not, is just inflationary. Walking away from fossil fuels and going into, alternative energy may be the best thing for the environment, but it's not necessarily the best thing from an inflation standpoint. It's much more expensive to run your economy without oil than it is to run your economy with oil. So it's a political dilemma that the nation's just going to have to deal with. And there's no incentive. You're sitting on the board of Exxon right now to get into some long-term exploration contract and do a bunch of, capital investment when the political will is to get rid of fossil fuels. So it's a dilemma. So it's hard to answer. I expect that gas prices and oil prices will maintain loft until there's, either a change in the political agenda or, these alternatives become a whole lot cheaper.
All right, I'm going to wrap up now because we are quite a bit over time from those 35 slides that we promised you.
Sorry.
I'm going to combine a couple questions though into one for you and give you three things to talk about quickly. How do you feel about high-flying tech stocks, gold, and cryptocurrency?
High-flying tech stocks and cryptocurrency are the same thing because they don't generate profit, right? The challenge right now in this moment, if you look at like venture capital fundraising and some of these other measures, if you're a company that doesn't have profit, it's just going to be hard to raise capital right now. So trying to issue more stock for Snapchat or, whoever it is, it's just going to be very difficult. And so we had gotten to a level where I think 40% of the companies in the Russell 2000, the small cap indice, didn't make money, which means they have to go back to the markets time and time again to raise money. Those windows are closed. So I don't want to be anywhere near profitless technology until we get on the other side of the recession or maybe in the midst of it. But that's never a big portion of our portfolio anyway. There's a little riverboat gambling there. That's not what we do. I do like technology that makes money. Like I said, there'll probably be a pendulum swing back towards growth, but I'm not interested in that. As far as gold, gold is a store of value. It's really the anti-dollar. So the answer to what do you think gold's going to do is what do you think the dollar's going to do? I do anticipate that the dollar declines, but it's really hard to forecast. Gold has been a huge disappointment because inflation's been so high. Gold prices should be up, but they're not. They're down like 20% from the high. Why? Because the dollar's up. So gold is just the anti-dollar. If you hate the dollar, buy some gold. But there are a whole lot of measures in play, and I wrote about that last week as well. And then the cryptocurrency thing, that thing exists only on the pleasure of the crowd. If the crowd gets big and likes pouring money into it, then it works. It's the most seductive narrative I've ever seen around a financial asset. It's the best marketing machine I've ever seen around a financial asset. And when it's working and sentiment is positive, then the price will rise. When it's not working, sentiment is negative and Coinbase is getting beat up, et cetera, then the price will fall. We don't own it as an institutional asset class inside W&A. It's just a little too bizarre and it's not regulated. It's not liquid. It's not transparent. And we require those things. But I am somewhat encouraged that it's held up. Bitcoin has around this 20,000 level, but it's for gamblers only and we're investors.
All right. Well, thank you again, David. This was absolutely fantastic. And yes, to someone who asked, will we have a replay available? We will get that out to you. You'll receive an email. It will also be posted on our website. Feel free to also follow us on all of our social media channels. You see those right there on your screen. We are on Twitter, Instagram, LinkedIn, Facebook, and as always, the best place to receive information about Waddell Associates is to sign up for our weekly email that comes out every Sunday morning. And 99% of the time, we'll have David's weekly thoughts, unless we occasionally let him take a vacation. Thanks again to everybody for joining us. We're so delighted you did, and hopefully we've provided you some clarity and comfort today.
Yeah. Thanks, guys.